or Brent down nearly 1% in early trade, with some concerns overnight of inventory building this week in the US data. Let's start off this morning with Ole Hansen, Head of Commodity Strategy at Saxo Bank. Ole, it does feel a little bit like this market is running out of steam after getting above that very high level of $85 on Brent. It's sort of stalling along with the global economy, perhaps. Your thoughts this morning?
Well, good morning, Sean. It most certainly looks like that even though we have this very bullish backdrop with tightening supplies all around the world, we are seeing the market running out of some momentum here. We've seen that already for the past few weeks, that even though the market's been going up, we've seen some net selling coming into the futures market from speculators. So it could potentially indicate that we may have just reached a plateau here from where we potentially then could move higher as we move deeper into the end of the year, but for now, maybe a $3 to $4 correction is in the cards. I think we're seeing some of the other commodity markets. Once again, China is stepping in their efforts to curb prices. Coal prices are almost down now by 50% within the last 2 weeks. So we are seeing some weakness elsewhere as well. And I think that's also just describing what we are seeing right now generally in this commodity bull run, that it's going to be a very volatile one. So obviously we will see these corrections, and they can be painful on road on as we go along. But generally the upside is still there, but at least in the short term. Also, I think as we look at the virus once again making an appearance around the world, potentially just creating some nervousness in the market.
The oil price is down a bit on this inventory build, but let's bring in Rustin Edwards, Head of Fuel Oil Procurement. Rustin, a bit odd that we've seen in recent weeks inventories building rather than that continued trend of decline. There might be exceptional reasons for that, because it does appear the overall narrative is that demand is greater than supply.
Well, I mean, we are in the seasonal building period for a lot of the crude oil stocks right now. Turnarounds usually increase going into October, November for a lot of the refining sectors. Currently, roughly about 11.5 million barrels of refining capacity is offline, of which about 7.5 million of that is for maintenance reasons. So to see stock builds in crude at this time of year and product draws is not a surprise. I mean, that's kind of the standard trade this time of year. Expect that to flip the switch coming into November as refineries come back. Distillate demand looks fairly good, but there are logistics constraints in a lot of areas around getting distillate to market. Namely, if you look at ARA, you've got low water levels on the Rhine, which are keeping the logistics systems rather tight because barges can only get to about a 60% capacity before they go down the river. So that leaves a lot of stocks building in ARA, which is kind of counter to the big demand profile that everybody's talking about. But nevertheless, if you go down Rhine, it's fairly tight because you just can't get the oil to move or down the river as quickly as you need to. So, I mean, it's still seasonal at this point.
Richard Radoglia, Chief Executive Officer of Matrix Global Holdings, sitting in California. Richard, we've been talking a little bit earlier in the week about, can this continued sort of upswing in oil markets, in prices, in equity markets, that sort of general inflation narrative continue while growth, GDP, we're seeing in China, it's coming off, the US may be coming off, this emerging phrase of stagflation. Is it a realistic fear?
Yes, thank you, Sean. Thank you, everybody. I think it's realistic to assume that, where we put ourselves with the amount of money printing that's gone on, with all of the inflation that we're starting to see. But I think there's a bigger story here. And the bigger story is I think we've seen a massive macro trend that's developed, and something we have not seen in, I believe, if ever, really where we are right now. I think, the best way for markets to go up is to go down, really. We had this move a few months ago where the market fell $10 or $9, and everyone got short, and it took them all out. And I think people who want to be bearish got short and they got taken out. I think this market will continue to move higher. I think the dynamic that we're in place here, we're in the second inning or third inning of what can be a significant increase in oil prices. I think the COVID has had a I know for all the bad things about it, and it is terrible. No question about it. It has been a blessing for OPEC. I think if we go back to March 3rd of last year, OPEC broke apart. Russia was being put to the woodshed by the Saudis. And you can go back at any point in time over the past 40 years and watch when Saudis come in and they decide to put people in their place, they raise production. And that leads to a long period of downward price movement, choppiness and downside. But this time it happened 2 weeks before the US shut off all travel to the US. And COVID basically came along and caused a massive demand collapse. A number of things happened. It collapsed prices worldwide, which shut down the debt-laden Permian producers. It forced Donald Trump out of office. Trump was going to be the energy czar, increase U.S. energy policies across the gamut. We were seeing it happen in real time. It got Biden put in place. What did he do? He stopped Keystone and he stopped drilling on federal lands. It accelerated the green agenda. And all of a sudden, we went from March 3rd with OPEC breaking apart to where are we now? 1.5 years later, with prices at the highest backwardated state we've seen. We had still continued to see massive money printing. And I think everything we're seeing, stagflation, demand, I think it pales compared to the demand supply balances that I think are coming at us.
Ole, what's your thoughts on that? This period being a great gift for the resurgence of OPEC. We have that top headline on our news digest today of the Aramco CEO expressing rather dramatic language of concerns around the lack of investment in new capacity, which inevitably with it brings volatility. Is this indeed a period good or not so good for OPEC Plus? Your thoughts on that?
Well, I think if it's a very high price, that's the target, then it is a very good time for OPEC because the field of competition has been narrowed down quite significantly during the past year, and the whole movement towards the green transformation is just leaving so much or reducing the investment coming into the sector dramatically, and we just have to basically acknowledge and accept the fact that we are not going to go green anytime soon. We need fossil fuels for a number of years, and if we don't invest into the area, then we will experience a very prolonged period of time with punitively high prices, which will hurt growth general and also make the green transformation even more expensive. So it's going to be interesting. I think this week we got the 5 big oil majors reporting their results. I saw an analysis indicating that they had generated free cash flow close to $30 billion. So it's obviously going to be very interesting to see how they're going to spend that cash, if they are increasing their investment or their capex towards fossil fuels, or whether it's going to be diverted towards windmills and solar. So I agree that this is as much going to be a lack of supply-driven rally than the demand-driven, because we are already now seeing economic growth starting to be negatively impacted by these punitively high prices, especially gas prices here in Europe and in Asia. So yes, it's a supply-driven rally potentially more than a demand-driven one.
Rustin, I was on Oxford Street the other day in London. I don't think in my few many decades visiting that street have I ever seen it so intensely packed. There was literally not another step to stand on the sidewalk there, and they are already 10-meter wide sidewalks. The spending consumption patterns at the moment seem to be on hyperdrive. Is that reflected on the shipping side? Are we still seeing bottlenecks there, or is that easing up?
Unfortunately, the bottlenecks are still there. I think last time I said there were 79 container ships sitting off Long Beach. The Port of Long Beach has changed the regulation on container stacking to try to get more boxes off the ships and get the ships out. Because as the oil spill that recently hit Huntington Beach, which breaks my heart because I used to surf there a long time ago, but nevertheless, it was to see that happen because a ship dragged anchor. That's the associated risk of having this bottleneck log jam happen. But nevertheless, I think the logistic constraints are still going to be there. I was reading a stat from the Bureau of Labor Statistics that there are over 80,000 job openings for truck drivers in the United States. There's a lot of people who aren't taking on that role, which is key to the logistics flow around the world. So I can just imagine the same issues happening here in Europe. And one of the things that I've, not to digress on this subject, but the curiosity about all this is that the fact the baby boomer generation is getting to the retirement age. And how many of these worldwide job, the lack of job seekers, job finders, the fact that you had people who were in their late 50s, early 60s who took their government bailout or furlough money, put it in the bank account and said, you know what, I don't need to go back to work now. And now you have massive job slack because you don't have people to fill those jobs that those people were doing pre-pandemic. But nevertheless, the freight rates on tankers are picking up because of the demand for a lot of the fuel oil, crude oil products for the dark side. Clean product demand is picking up as well. You've got jet fuel arbitrages that are opening up from east to west. There's a lot of hope that the jet demand will pick up, that COVID will not overwhelm the world once again, as we're starting to see cases building in China. China's already locked down one city of 4 million people. They've curtailed internal jet travel over this week. Russia's gone into a small lockdown around Moscow and the surrounding provinces. You've got buildup in COVID cases in the east. So that to me is always the flag on jet demand and fuel demand going forward, is how bad do countries react to COVID. Dry bulk.
Richard, go ahead.
I'll make this quick. Dry bulk.
No.
Starting to see a pullback in value because of the curtailments that a lot of the demand centers are happening, like in China. They're releasing strategic stocks, causing less demand to come in from the shipping sector. So we're starting to see a pullback in the dry bulk sector right now.
And Sean, if I may just add,
yes, please.
You mentioned Oxford Street. I was there as well a couple of weeks ago. Maybe they're just rushing around because they're worried that we're going to run out of stock before Christmas, because all the Christmas presents are still stocked at Felixstowe. So that could be another reason why there's all these worries that the goods are not going to reach the shops before Christmas. So you never know.
Well, it certainly had a sort of panic feel that sort of evening before Christmas, that Christmas Eve. Daddy who didn't do his shopping is now running wild in October. God knows what that means for the rest of us.
Stocks.
Exactly. Don't expect too much under the tree this Christmas. Might be a good thing. Richard, we are sort of looking at this either stagflation theme, but also where the monetary policy makers will be incentivized to move and to shift their policy stance. In the in wage inflation piece, which is seeming now to be having an upward momentum on it, given the shortage of talent, that given that we've had the hourly rate in the U.S., the minimum wage rate at $7.50 for 20 years, and that it is not a livable wage from a long time ago, that perhaps there's a lot of run still to go on the wage inflation before the central bankers will take action, because clearly it hasn't moved for a long time. Your thoughts on that, where that inflation and wage inflation impacts policymakers?
Well, inflation, it's wage. I think it's wage pull and cost push. We're getting both, right? And so when we say $8 an hour, my pay was $1.25 an hour when I was a kid, so it did go up. And it's not meant to be a livable. It's meant to be a wage for a teenager to get in there and work. Wages are everywhere up. Every single place you go to is up. People cannot get you cannot go to a store. You go to a market and there are not enough checkers. So I think the issue is we're going to see inflation. And where does inflation show up? It shows up in commodities. And when it shows up in commodities, it happens, which is really a cost push, right? Which I think we're headed towards in spades. We're doing nothing to stop it either. I think I read today, if you all guess what is the Fed doing today? They're printing $120 billion a month in quantitative easing, $120 billion a month as our economy grows. I think we're in trouble. I think that the markets are going to get away from ourselves. I think energy is incredibly unique. This is an incredibly unique situation, at least in my belief. I know stagflation, demand, all these other little pieces. I think this is an incredibly unique situation that we're looking at. up until, if we go back when we had oil crisis in the past, if we go back to the 80s, and really the 80s is the key, the markets were able to correct. They were able to adjust. Majors were able to come together and increase production. They increased their pipeline systems. They did all of these things to allow the flow of oil to move. We're doing the opposite now. We're closing our coal plants. We're closing nuclear plants. We are not producing, I think Ola just said it, we're not putting money into CapEx. You talk about the majors. I watched a 22-year-old girl the other day on TV, it was in Europe, sit next to the chairman of Shell and chastise him for destroying the climate. And I thought, and he kind of hung his head in shame. And I thought to myself, you should get a book from Hayek, hand it to her, and explain economics. Because what is happening is a collective disconnect is happening in real time. And I might be throwing kind of fire on the flames here, but I don't think we've ever seen something where collectively the people who have controlled energy and allowed us to move through policy over the last 40 years basically pull it back and say, hey, you know what? You don't want us anymore? We'll stop right now. And I think the key factor is, you said something about Aramco. The Saudi minister came out yesterday and said, let's not take this rebound for granted. We are not out of the woods. We've handed the keys of the kingdom and the race car to Saudis and to the Russians and OPEC Plus. And we're saying, I hope you drive this car really nicely because we're counting on you to get us from point A and point B.
Well, on that, Ole, do you concur with that point that there is no shortage, that where supposedly OPEC Plus still has 5 million barrels of idle supply? So that CapEx spend, maybe they won't put it towards new supply.
Well, they on paper they have, but we've seen recently with both Nigeria and Angola how they've been struggling to actually meet their quotas. So so I think that it is still a big if whether that capacity is really out there and can be applied to the market. And I think the market is also getting somewhat nervous about this kind of softly approach we're seeing right now, because we're seeing more and more calculations now indicating that the gas to oil switch alone is somewhere between 500,000 and 1 million barrel in additional daily demand. And if we only get 400,000 barrels on a monthly basis, then it doesn't take long to work out that we are in a very tightening market. And also it was mentioned earlier with Richard that what we're seeing at Cushing right now, that we're getting a year and a half ago we were hitting tank tops. Now we're potentially getting to levels where the system is not functional if we continue to see draws at the magnitude we've seen recently, and that basically would just blow out the spreads even more, because it's still Cushing is still the delivery hub for WTI futures. So yeah, it is. I think we are in a challenging aspects, and
the backwardation is still there, right? The backwardation in the market structure seems to be quite steep, and so not encouraging.
Exactly. Over to you, Richard.
No, but you said still there. The first 5 spreads in WTI are average around $1.40 a month. So the first 5 spreads, equally as important, the U.S. Gulf Coast sour spread to Brent to WTI was $12 or $9 gas, heavy crude, sour crude, because of what Saudis were doing over TI. It's now $5 under. It's the lowest price it's been in 7 years. $5, $4.50 under. I believe when the U.S. Gulf Coast comes back online, we get WTI Cushing. All just said Cushing storage under 28 million. I would think we can see the Mars spread, which is the sour spread to WTI, reach $10 under, or TI $10 over, which shows you there is not enough crude there.
Rustin, your thoughts on that point, and also on the outlook for shale oil. We've got this big profit surge in both the majors and the independents who hadn't hedged. There's going to be some pretty powerful earnings over the next few days.
Continental Resources, I think, had a fairly strong, robust balance sheet report they just came out with theirs. You've got the interesting thing about the shale industry right now is that the amount of hiring going on in the Permian Basin has been on a tear over the last 5 months. They had another additional 3,000 new employees join up with the shale patch, which is a fairly large amount, especially now that they're hiring more specialists on the recovery and the operational side versus just general labor. So, I mean, there will be shale coming back. I think that at the end of the day, though, much to what Ollie and Rich has been saying, the lack of forward investment has really put a crimp on how low can prices really go. I mean, unless we have a major economic breakdown here with recession and stagflation coming in Q1, Q2, do prices correct below 60? Probably not. They can stay up here at these elevated levels. And if anything, I put more credence to a $100 crude market in 2022, 2023, as the lack of forward investment starts to bite. But I think shale has a very good place to come back. I think they can come back both in the Bakken and in the Permian Basin. And I think we'll start seeing that materializing as we move forward.
Let's give everybody else in the room a chance to comment on this stagflation topic with the survey question this morning. The 1970s all over again. The stagflation debate is splitting Wall Street, and that is the headline from the top market story on Reuters this morning. My question to you is, where do you stand on the likelihood of stagflation emerging as an issue in 2022? Yes, it's likely. No, it's unlikely. We've seen Sorry?
I think you have to put a bias in there for people who have actually lived through the 1970s stagflation.
Well, I always blame it on my parents' divorce, to be honest. That's another story altogether. But it's something we've seen in Japan for some time. They tried to print their way out of it, and they seem to finally get here. Ole, your thoughts on that? If indeed it does emerge, it is emerging, what is the consequence for the oil markets, commodities?
Well, if it does come, then it will be the inflation part of, basically it would be self-strengthening, because we got rising commodity prices into a weakening demand, because the commodities are rising not due to demand but due to lack of supply, and that's and if that's the same time is leading to lower growth, then obviously we do have a problem. Stagflation, there's different ways of describing describing what stagflation is. I think we're probably not going to get to that point, but we most certainly will get to a point where we continue to see higher commodity prices and with that lower growth. One potentially part that could alleviate some of the pressure on commodities is China, but at the same time, if China gets a big cold, then obviously the rest of the world will shiver as well.
Well, on that point, where do you see China going into the winter now? We've seen obviously the GDP number print for the third quarter being quite low. Where does it end up the year and its own winter with the cold spell already kicking in there?
Well, we've seen some of the measures taken by the government over the past months, clearly indicating that they're worried as well about the availability of supply of fuels into the winter. It looks like they've been somewhat successful just recently with their latest interventions. Coal prices has almost halved now over the past couple of weeks. So and some of the other commodity prices are coming down as well. But eventually, if it's driven by lower production, which eventually will be needed. So again, then I think we will see a slowdown at least until January, February. We've got the Olympics coming up as well. The specific reasons to keeping the skies blue as well. So it will be a bit of a tough winter for them from an economic perspective as well. But there is still the expectation that the green transformation around the world will pick up some of the slack that we may see in Chinese demand. And again, fuel is 10% going to China. The rest is to the rest of the world. So even though we see maybe a small slowdown in Chinese demand, then it's not going to impact the overall tightness in the oil market, I would say.
Richard, we still have some further stimulus discussions in the U.S. now with this Biden bill sort of limping its way through Congress. Your outlook for that, as well as some of the kind of politics are getting back on the front pages, a big election in Virginia.
Yes, and an election also in New Jersey. The person who was running in New Jersey was 26 points behind Murphy. He's now 6 points behind him. McAuliffe, if he wins, he wins. I mean, what can you say? I think that they're trying to force a square peg into a round hole here. We're basically held by two senators who are basically dual presidents now between Sinema and Manchin, who do not want to raise taxes. We're going to do a wealth tax now. The United States is going to have a wealth tax, which is going to be get your countries ready to take in a couple of billionaires because they're going to probably be leaving the United States. But they're talking about.
We're always welcome in Dubai. We have a special place for billionaires.
Well, Elon Musk
with the heavy suitcases, of course.
Elon Musk might be showing up there because when he left California, our governor Newsom said, we made Tesla. Tesla wouldn't have succeeded without us. So that's how our politicians view success here in the United States.
Well, Obama did give him a very nice $500 million when he got started.
He did give very nice.
A nice welfare check came to Mr. Elon Musk at the beginning of Tesla.
And two things happened. If you saw, the value of Tesla went up 2 days ago. The one-day move in Tesla was greater than the combined value of GM and Ford. So I thought that was an interesting stock move.
Was that on the Hertz booking of 100,000 cars?
Correct. The Hertz booking of the cars. And in this green energy bill, there's another, I think, $9,000 per Tesla if you buy one all the way out to 2031. So that's part of this bill. It'll be just a continuation. You can't even. We never used to say back in the 70s the word trillion. Now we say it as a matter of course. So here we are talking about $2.5 to $3 trillion of new spending over the next few years. This will lead to higher inflation, commodity prices through the roof, and I think we keep on forgetting. Let's not remember OPEC plus. OPEC plus with Russia is controlling it. Never in history has demand year over year been lower and a market been in backwardation. We're now approaching $17 backwardation on a 1 to 18 month spread. So never in history has demand been lower year over year and a market in backwardation, and we are approaching highest levels of backwardation almost ever. So OPEC plus is in control. Let's not forget that. What they do and what they say and how they approach this, to me, is probably the most key factor in what's going to go on with oil prices.
It's certainly been a good year for Russia, that's for sure. Let's get the survey result and give Rustin the last word this morning. Stagflation likelihood in 22. Yes, it's likely 2-1 on this room's view. Rustin, your thoughts on the outcome of that survey, but also the sort of impact or the appetite for more stimulus from the U.S. government. Is it indeed something people are sitting on the edge of their seats waiting for?
Well, I mean, I've always been a big proponent that the high cost of goods, transportation, freight, oil is going to lead to an inflation bomb that's going to hit. We're starting to hear it hit it. It's starting to hit today already, and it's going to continue to impact the economic growth going in through Q4 into Q1, Q2 next year. And it's a reality of the fact that you do have strong OPEC plus compliance. Nevertheless, everybody forgets that you got Iran with 1.5 million barrels still sitting on the sideline, depending on what happens with the U.S. and JCPOA meetings. You got Venezuela, which could easily put another 2 million back into the market if the sanctions relief was put against Venezuela. So is there spare capacity? Yes, there is spare capacity. There's probably 4 million barrels that is quote unquote untouchable spare capacity, but it's there. And you've got shale, which probably has another 2 million barrels of spare capacity. It could come back if you had the unbridled release of production in the United States once again. So there's ammunition in the well. It hasn't been fired yet, and it's still sitting there. So prices are purely inflated on the back of supply. Now, with the cold winter that could come up with La Nina, what happens, that could exasperate everything forward, which puts more drag on the economy, puts more pressure on the consumer at the end of the day, because our cost of all of our goods keeps going up. And that's just going to keep us into unfortunately, a downward spiral, in my opinion. Every time we've had these types of unbridled rallies in commodity prices, the fall has always been quick and dramatic. You can go back 2008, 2014, 1984, yada, yada, yada. And the price collapse has always been quick, catches a lot of people off guard, and it will happen. I think that in the United States, does the spending bill happen? Does it not happen? I think the infrastructure investment needs to be done in the US, because the infrastructure in the United States is purely lacking. Port facilities, roads, rails, everything. They all need to be upgraded, brought into the 20th century. They're in the 18th century now. They need to be brought up two centuries.
You wonder in some ways if it's a bit late. The American empire will expire before that high-speed train will get built from California to New York. But we do need to wrap it up there. The oil markets are trading a little bit down today, but still at $85 a barrel. Interesting interview this morning on the Halftime Talk series with Dr. Qiang Liu, Secretary General of the Global Forum on Energy Security in Beijing. And one of the things he said, which I took some note of, is that the Chinese people need a better quality of life, that the happiness quotient is quite low. And speaking of inflation, people in Shanghai and Beijing and the major urban centers in China are spending 50%, 50, on average on housing, on real estate. So inflation is already burning a hole in their pockets and their spirit there. I'm wondering how long that can last without it be bubbling up to the surface in some way in China. Anyway, some interesting insights from Dr. Liu. Thank you, Ole, for your time this morning, as always. Richard, as well, from California. Rustin from Geneva. Really appreciate the insights. And we'll catch up tomorrow morning, 10:30 UAE time. All the best and have a good day.
Thanks,
guys.